Hi, Joe Lopresti here with the latest Arlington Wealth Management Proactive Strategy Update for Friday, July 14th. Since our last update, we've seen pretty noticeable improvement in our core indicators as the market breadth or participation in the market has expanded. More industry groups, more stocks have been participating in the market uptrend over the last several weeks. And that's a sign that we've been waiting for over the last few months, that the market low and rebound from 2022 is gaining traction. Things stalled out right around the time when we had the regional banking issue in March. That's when breadth started to deteriorate. Now we've seen it gain traction, and that's a good sign. So today we're going to review our core indicators. We'll show you the improvement that I'm speaking of. We'll also review our recession warning models with the latest update there. And that continues to be the thorn and preventing us from getting to a fully bullish stance with our investment strategy. So let's take a look at our PAS dashboard. And first thing we can notice is now all core indicators are back in sync with the positive arrows. That's the first time in a few months that that's been the case. We've seen improvement really in all three of these indicators since our last update. So let's take a quick look at each. Starting with the cash comparison charts, we could see that we've seen now some follow-through with the uptrend that has taken place off of the September, October of last year's low. So we pointed out that we had a reversal in March that was during that mini regional banking crisis, and then it reversed up last month, and we wanted to see it follow through on that reversal, and now we've seen that happen. So that's a positive progression on this chart, indicating that what this is measuring is the rate of return in the global stock market relative to the rate of return in cash investments. So it's a coincidental indicator, and it does indicate that we're seeing a good follow through to the trend. The other positive development is on the logarithmic chart, the relative strength chart. It also has followed through. It stalled out a bit there in February, again waiting for that March, April, May timeframe to pass, and in July we've now seen a higher high. So from a market cycle perspective, these are positive signs. So the next one we're going to review is the long-term momentum chart. Very simple and straightforward. Month-end June, continued positive momentum. So you can see a little bit of a breather there again in that February-March timeframe, but now we're seeing some regained momentum, indicating that this bull cycle is developing further. And then our universe trend indicators. You could see on the traditional scaled chart, after rising and then hitting the peak in February, there's the reversal in March that indicated that breadth was deteriorating. And then it kind of stalled out in April, May, not a lot of movement, even though the market itself was advancing. But now we're seeing the numbers improve again. And we're essentially back to the same level we were in February. Next step would be to see this chart continue to advance and surpass the February high. The market itself has surpassed the February high. So ideally we want to see breadth expand further with the market. The logarithmic scale chart is essentially still at its February high. You could see it hit 58% on the way up, and it's right there. Never did drop enough to reverse like the traditional chart did, but here again, what we'd like to see is some follow through and this continual advance of this rising column to get to 60%. And that would indicate, more stocks globally, more industry groups, etc., are participating in the uptrend after stalling out there for a few months. So having those core indicators back in sync is a good sign. The global buy signal happened on November 30th. The first couple of months, there was a pretty strong broad-based move in the market. Then we hit that area of time when the market movement was very limited to just the mega cap growth companies. Now we're seeing the advance expand and broaden out, and that's a solid sign. Now you do see one red area on our dashboard, and that's in the tactical indicators. Our overbought oversold indicator is beginning to get to an overbought position. Let's take a look. So what we're looking at is the yellow line is the daily movement of the MSCI All Country World Index, and the channel that we construct is a statistical evaluation of how the index tends to move during all of the previous bull cycles in our model history, which goes back to 1995, so a little over 23 years of data. So how do we define a bull cycle? Well, it's all the days that our global model is on a buy signal. So you can see we've been on a buy signal for 153 business days during this cycle, taking all of the cycles going back to 1995, and it's the vast majority of the time. The model is on a buy signal about 85 or so % of the time. So during all of those days, we then take a look at where the market index is relative to a key moving average, and that's the white line on the chart. It's a 210-day moving average, and then we calculate statistical variance from that moving average. And we know during all of those days, typically the market is going to be trading right at this blue line, which is what we call the bull trend average. And the bull trend average tends to be about 5% above the 210-day average. So that's where the market typically is when we're in a bull cycle. During bear cycles, it's a much different story, and we'll save that discussion for when we do get another sell signal sometime down the road. Then we construct statistical bands around that average, and you could see we're getting up into that red zone, which is about a 1 standard deviation above the bull trend average. That's overbought level. The oversold level is down in the green zone. So for the first time during this bull cycle, we're getting to a overbought condition in the market. That's not a ceiling or a lid where the market can't penetrate through it. It certainly can, but it does indicate that the extended move that we have in the market just limits the ability for the market to make a big push from here. It could stay overbought and continue to trade overbought for a while longer. At the same time, we could also see a correction develop when the market gets overbought, because it puts a fair amount of air underneath the market if some negative news were to develop to cause the market to start to correct. So when we look at this indicator, it's part of our tactical buy and sell signaling in our model. One of the criteria we look for a tactical sell is an overbought market condition. Now there's other criteria we look at. The other criteria are not confirming that we should be tactically selling. And if it did, what we would do is we would sell partial positions in our growth assets to reduce our exposure to the market and expect a correction to develop. But what's holding us back are a couple of things. First is the 10-week chart is not overbought. It's in a neutral position. It's at 62%. It would have to rise about another 12% or more to get to its high risk or overbought level. And we really like to see both of those indicators at their respective high risk and overbought positions before we conclude that the market move is really extended and is unlikely to continue to push higher. The third criteria we look at for a tactical sell signal is the number of days that the market has been on a buy signal. So, we're in that 7 to 8 month period right now. Our research shows this is still very early in a potential new bull cycle to tactically sell. So markets can hit overbought conditions in an early part of a market trend and continue to stay overbought and continue to trend higher for a while longer. Now, if we get another few months into this cycle and we're still at an overbought condition, that may prompt us to want to take some of the growth assets and reduce exposure there and prepare for an inevitable correction in the market. So the market model has developed nicely, and we had a little bit of concern there for a period of time when breadth was not strong and we were seeing very narrow leadership. The latest market action is encouraging for this market cycle. Let's take a look at another one of our models, our recession warning model. Now here we see a bit of a different story where the recession warning model has been negative for about a year. It was middle part of last year when these lines dropped into the recession zone. These are forward-looking indicators, so we expect them to drop into the recession zone well before a recession starts. And you could see that they dropped into a pretty respectable level in terms of being able to predict a recession. We've now seen them kind of stop deteriorating, but they're still well into recession territory and would indicate that eventually we'll have a recession. Now the length of lead time is going to vary from cycle to cycle. You could see in some cases these indicators can get into recession warning well before, a couple of years even before a recession develops. Other times that happens maybe a little bit quicker. So this time we're now about a year in, probably not in a recession right now. If we look at the latest economic data, has actually been strengthening just a little bit. But one of the things that we pointed out when we got the buy signal in November is that our recession model was negative then, and we questioned how long a bull market can last with our recession model negative. And we laid out a few scenarios. One was, well, the recession is going to develop in the near term, which would limit the ability of that buy signal to be successful. And we gave that a low probability. The second scenario was that the recession is going to occur, but it's going to be far into the future, giving the market a runway to have some solid gains, because stock market typically peaks 3 to 6 months before a recession. So depending on when the recession ultimately begins, that would really determine how much time that the market could advance when we got that November 30th buy signal. So we now know that we didn't get the near-term recession, which we gave a low probability. We gave the highest probability to that recession occurring sometime late 2023 or into 2024. Today I think it's probably unlikely we get one in the near term, say by the end of the year. It's still possible. More than likely, it's going to extend into 2024, which could still give the market a little bit of runway to advance. In fact, the latest improvement we're seeing in our core indicators is indicating that we're not likely to hit that recession in the near term. Of course, if that happens, when that happens, you would see some impact on the corporate earnings, and you would see much different action beginning to develop in the equity markets than what we're seeing today. However, this still is a looming negative cloud over the market. At some point, we would expect that recession to develop. There is a small possibility that we could escape a recession altogether. When we laid out the scenarios back in November, we did throw out that possibility, gave that a low probability as well. And our base case was that the recession would occur, but it would be much farther than what people were expecting at that time. And we still believe that's the base case. Now here's the weekly leading index, and you can see that one has been edging up over the last several months. Still in recession territory, but has been improving as we're getting some of that weekly economic data on the mend a little bit. But the takeaway is typically you get a drop below the zero line, eventually a recession occurs, and if you remember the markets back in 2001 into 02 and of course 2008, the last two major recessions, except for COVID, those were very deep and long bear markets, and that's why we monitor the economy. And if there's a possibility of a recession, we want to be aware of that, and we want to take positioning with investments with that in mind. So in summary today, we're seeing much better market action overall with better breadth, better participation. You see that with our core indicators all improving. Tactically, the market's getting a little extended, a little overbought. Generally, that's not a concern this early in a bull market. So we won't take any action due to that one indicator being overbought, but we'll continue to monitor that and our other tactical indicators to decide when we would want to start tactically selling some of the positions that were purchased during this campaign. Better breadth indicates that a lot more participation. Many of the asset classes that we've invested in have been performing a lot better in recent weeks. As we saw with the economy, the numbers have stopped deteriorating, but they've done so at a very troubling level, indicating a recession eventually will develop. And the question is when and how much more runway does the market have before that recession develops. Well, we're going to continue to keep you posted on all of these progressions with the models in future updates. Thanks for watching this week and have a great weekend.